Good morning, MMTs. Here we are. We're gathered here today about these option contracts on Priceline. This is a 510 put, okay? It's one that's fairly close to the strike price because the name closed around 513 and some change. We already have those other live videos for you. You can see over here on 2/20 of 2011, these put contracts at that time were $94.80. $94.80. What I am going to say over here now, that 1, 2, 3, 4 weeks later, that same value that I just pointed out now is at 9.70 on the low. Let me tell you, though, that the high for the week of 327 and until last Friday for the weekly range is that they went from $29 on the top side right here down to that low of 970. Now, granted, when we looked at the weekly chart on Priceline, is that in our first video series with MMT's training on understanding where stocks go and how overbought that they start to get. So basically on the weekly, 90.84% here, that's extremely overbought, where big money will eventually start to take profits. So as we come down in the premiums here, these are very deflated in value, so that when we get so overbought in the equity name, and here are all the various different strike prices that we're looking at. You can see we have a lot of them. We have a 490 put, a 500 call in the money. Why? Because we're looking at the imbalance premium adjustments, the open interest on the contracts. It just so happens to be the biggest open interest on this one, which is very light, but it's still 2,224. They believe the 550 up and out of the money makes a move. What they don't realize is, though, when you take a look at that call contract, it's down here. It was very cheap over here, and it's the kind of contracts that when you're taking a name like Priceline on both sides of the market, you need to be buying these up and out of the monies down here for like 10 cents. Because when you're looking at the bear count and the bull count on the name, you got to factor in the volatility, dollar cost risk management trade. And that's always taking something for 10 cents here. That was way up and out of the money, buying 100 or 50 of those contracts for $50, so that if you move up and your short was to go against you, well, if you bought these here at 10 cents and you had 50 contracts up and out of the money, the high was 220. So you'd be making $2.10 times 50 is over $10,000 by understanding how to use the SMF options, calls, and puts, and up and out of the money to control long and short trades intraday between the public tape, so that if there's volatility and the shorts get squeezed, hey, for down here at a dime, you're making a lot of money on 50 contracts. You're over 10 grand. So when we start taking a look at how we're going to do the trade, so if I'm looking at a put option and I bought those there, now it gives me the ability to come over here and start buying that put side wholesale. And it's always understanding in your first market maker, not intraday options market maker in the pit, but outside of that is how they maneuver outside. Yes, they steal and take lots of money on the intraday level, and that's what we do. But then we also, on the other hand, do some other ones like this. And when you're going to be shorting something as strong and as high beta that Priceline is, it pays that when I had my guys buying this contract over here a couple weeks ago when they were at the all-time low, 10 cents. And that, you know, and so that way there, those profits for 10 cents are paying a lot of money on the short squeeze, because the name Priceline, once again, has been breaking out to all-time highs right here on the weekly. So when we look at doing these kinds of trades, there's ways of entering them and understanding them and pairing the volatility risk between bear and bull, so that you're never caught on one side of the market. You've been given a gift. So that's last week The prior week is when those contracts were at the low, because they were. And if you'd like me to bring them up for you again, I can be quite thrilled to do the 550 call. At that time, you can see here is the call. That was 10 cents where you buy those, and they went up to 220. So when the bear got squeezed here and the bear got squeezed there, you were making money on that 10-cent investment to hedge. And if you were short, but none of our MMTs were short during that process, but you look at buying, this is a cheap side to buy for the up and out of the money volatility trade. It cost you $500 to be here, but now all of a sudden they're worth 10 because of the double weekly breakout. Where just the regular bear that's pessimistic on Priceline, they never get that profit, that debit, because they don't know what they're doing. So when we take a look, there's the name. Now we're going to take a look at the 510 put. Here's the $510 put right here. Here's that 550 call up and out of the money. And look at how cheap, once again, that the 510 put is. So if you own the 550 call up here for $500, you're up 10 grand. Now you can start buying the put side of the market. That's where you're going to be going when these things get planned out. As we manufacture them, you've constantly got to be on top of them. And you constantly have got to be looking at both sides, up and out of the money volatility, and where they just have been mutilating this put side. One of the things that we really love to rejoice in here at SMF is buying up and out of the money volatility very cheap for like a dime. Because that 10 cents, that $500 is nothing. So when we start buying over here, we already got 10 grand made here. Because we do. Now we start buying over here. Our risk is very limited because of the amount of that volatility profit that we got off of that $500 investment. You've been given a gift. We are going to be shorting this one with MMTs at the right time on Priceline. It's a very sophisticated intraday market management skill with the position management overnight skill, with the difference of being inflated and deflated, with the difference of understanding how to pair risk, that entry management with profitability up and out of the money and or below the market puts. Whatever the case may be, it will always work the SMF way.